Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. So we know that Donald Trump has been pressuring the Fed to cut its policy rate, and in a moment we'll look at the outlook for U.S. rates with Clayton Triick. He is head of portfolio management at Angel Oak Capital. But we begin in Japan, where Prime Minister Shigeru Ishiba says he is intending to stay on despite his ruling coalition suffering an historic setback over the weekend in the upper house election. The ruling Liberal Democratic Party and its longtime ally, the Komeito Party, failed to retain a majority in the upper house. Bloomberg Asia economy editor Yuko Takeo says this outcome may complicate ongoing trade talks with the U.S.
Japan is set to face across-the-board tariffs of 25% from August the 1st, barring a deal with the US. And so far, there's been nothing concrete to show after Japan's chief trade negotiator, Akazawa, has been to the US 7 times already. So now the ruling coalition will have to continue negotiations from a weaker domestic position, with the deadline for higher tariffs coming up.
That is Bloomberg's Yuko Takeo in Tokyo. For a closer look now, I'm joined by Shuntaro Takeuchi, portfolio manager at Matthews Asia. Shuntaro, thank you so much for making time to chat with me. Let me just begin by getting your reaction to the outcome of the election in Japan over the weekend.
Yes. So over the weekend, LDP Komeito lost its majority on the upper house election, which is basically another loss because they lost another election last autumn. So both houses, they have lost the majority. And going forward, it would be tougher operation of including the U.S. tariff negotiations and also internal domestic policies as they will need to negotiate with multiple parties going forward. In terms of the initial market reactions, obviously the equity markets is closed on Monday, but the currency has basically been flat or stayed basically the same. This is because over the past few weeks, there has been a lot of media reports that the LDP Komeito coalition is going to lose the majority. But given that the final outcome has only been, they lost the majority, but only by a couple of seats, it's basically saying that it is in line with market expectation ahead of the election itself.
So can we expect a lot more in the way of government spending as the result of this?
Yes, of course. Japanese government debt to GDP is at an elevated level, but many of the opposing parties who have called for many tax cuts and basically have their voices heard and increase their seats by quite a margin. So these are all negotiations going forward, but in terms of the directions, I think these kind of budgets will need to be a bit more expanded.
It's kind of interesting because inflation in Japan for a while now has been well above the BOJ's 2% target. Where do you think the BOJ kind of fits into this story now with the upheaval that we're talking about in the Diet, the Japanese parliament? Where does this leave the governor, Ueda, and BOJ policy?
So current market consensus is about 50-50 in whether the BOJ will raise rates by another 25 basis points within this calendar year and maybe another 25 basis points next spring. The BOJ, we think that is focused more on the wage growth, the real wage growth happening. So the spring negotiation of how much the wage growth will be seen from Japan corporates and its employee is the data that BOJ is looking very carefully on.
So we know that recently the equity market in Japan up until this year had been doing very well. I mean, we've seen a struggle recently. Are there still opportunities in the Japanese equity space in your view?
Yes, we think so. Despite the very anemic GDP growth for Japan as a country for multiple decades, it is important to note that Japanese equity markets is investing in Japanese corporate profits. And half of the profits actually come from growth in overseas. So there has been a steady earnings growth over more than a decade for Japanese corporates. And on top of this, especially over the past few years, you have seen many meaningful improvements in the corporate governance and also leading to higher payouts, buybacks, and dividends. And currently, Japanese markets are still trading at a substantial discount to European and U.S. markets, primarily due to lower return on equities. But finally, the Japanese corporates are making actions to improve that on that front.
Shuntaro, I'm curious as to how much of your optimism is tied to a successful outcome in trade negotiations with the U.S. And if that is your point of view, can you give me a sense of what you expect the effective tariff rate with the U.S. to be?
So in terms of the tariffs, I have to admit that negotiation between U.S. and Japan around tariffs have been taking longer time than we had anticipated. Export sector, especially automobiles, has been a victim of the uncertainty and impact of tariffs. And the amount of the percentage of the tariff itself, when we look at how Japan puts tariff on its U.S. imports, there's barely any, except for a couple of agricultural products. So I don't have like a set number of what is the optimal tariff rates, but as an investor, as a long-term, long-only investor, what we look for is to look for companies that actually weather through the storm and will actually come out stronger after this.
So are there industries, you mentioned the autos, I'm thinking also of steel when I'm thinking about trade with the United States. Are there industries that you're focused on primarily?
So currently, over the near term, we look for subsectors and areas that are not impacted by the tariffs, namely in like domestic industries within Japan that actually benefits from labor shortages, such as constructions, basically commanding a higher margin as a result of that. Also in software and IP, such as games and other areas, those have relatively limited impact to the U.S. and tariff negotiations. So that we are focusing on right now. However, we're not alone thinking the same thing. So we are also looking for these kind of impacted sectors being underweight by the widest margin in a couple of decades. So we're focusing and taking a look in these outcomes of the negotiations, but we're not setting any calendars of when this will dissolve. And it's taking a little bit longer than we had anticipated.
So let's move away from Tokyo and Washington and the tension that may exist on that front. And I'm curious about Japan's relationships with some of the other trading partners it has in the Asia Pacific, principally China. Is this something that you're also taking into consideration, that maybe that relationship becomes a little bit more meaningful from the Japanese side?
I think overall, I would not say that the globalization trend has reversed, but we think that the trend of globalization has at least slowed down, meaning to a lot of capital expenditure being more diversified globally. And our view is that actually benefits many Japanese companies that make critical components and services in the capital of expenditure, especially in the manufacturing sector. So because of these tensions, you can no longer consolidate every single manufacturing in a single country. Rather, you have to make things in the United States, you make things in China, you make things in elsewhere, which means that there will be a duplication of capital expenditure across the globe. And we look for opportunities that benefit from that trend.
So, Shuntaro, just to put a button on it, when you look at the dynamics between Japan and China, strengthening that trading relationship, that would be something that you would look for in terms of trying to find opportunity, right?
Correct.
Okay. Shuntaro, thank you so much. Shuntaro Takeuchi, portfolio manager at Matthews Asia, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. So we know the impact of the trade war on growth and inflation differs across economies globally. Now, here in the U.S., the potential for tariffs to be inflationary is keeping the Fed in this wait-and-see mode. Policymakers are now in a blackout period ahead of the Fed's July 30th rate decision. Now, in the U.S. last Friday, Governor Chris Waller reiterated his case for a rate cut. And Waller hinted that he would dissent if his Fed colleagues voted to hold rates steady this month. For a closer look now at the rate outlook, I'm joined by Clayton Triick. He is head of portfolio management and public strategies at Angel Oak Capital. Clayton is on the line from Atlanta, Georgia. Clayton, thank you so much for making time to chat with me. Is there a case to be made for cutting the policy rate as soon as this month?
Doug, good to be with you again. Yeah, we do think so. This meeting is obviously definitely on the early end. But if you do look across developed economies, thinking about where the current Fed funds rate is in the United States versus inflation, it's definitely on the higher end, i.e. the real policy rate is one of the highest levels. So there is an impetus to cutting rates potentially at this meeting. We think the likelihood is extremely low, given the Fed doesn't like to surprise the market, and the probability is almost 0% for this meeting. But that being said, we do think that rates could definitely be lower. That was our expectation, a few months ago, going into the year, and in our mid-year outlook, we do expect that the Fed funds rate, will most likely be moving lower, in the next couple of months.
I'm wondering about the tariff story because Bloomberg Economics is estimating that the average U.S. tariff rate will have risen to above 13%. It was at a little more than 2% back in January. Isn't there a risk that tariffs really create much higher inflation, and that argues for at least keeping rates on hold for the foreseeable future?
We do think that you could see, some bumps in the road here on inflation. That being said, kind of the overall tail risk that you would get a significant rise in sustained inflation and core inflation over the next 3 to 9 months, we think is a much lower risk today than it was just a few months ago. So overall, we think we could see some bumps. The last time we saw higher tariffs, that was a one-time pass-through. If you look at what's driving inflation, over the intermediate term, housing prices, rent prices continue to move lower. Actually, in some places, you're seeing falling home prices. That's 30% of PCE and 30% of core CPI is shelter. And with those headwinds there and the economy looking to lose momentum, we do think overall core inflation should not be surprising that much higher overall, and gives the Fed the ability to kind of look through to the longer term and potentially move rates lower, even if there's some bumps in the road modestly with inflation.
So let's look at the tariff story from the other side of the equation, that it begins to hurt growth. Obviously, that would argue for lower rates. But do you think the growth story is going to suffer a little bit as the consequence of tariffs?
Yeah, we do. We think growth is definitely continuing to slow. The economy has been losing momentum. We put this in our outlook, illustrating that GDP growth the last few years has continued to decelerate. You look at the labor market, we've also seen a fall in average payrolls. So last year in 2024, we had average payrolls over 150,000 per month. Now you're about 130,000 with last month's beat. So, all eyes will be on the labor market overall. But with the economy losing momentum here, and tariffs most likely will end up being higher, even if they're not as high as the initial fears after Liberation Day, that is negative for growth. And so that sets up well for what I think Waller's kind of pointing to.
So in the week ahead, we're going to get two reports on the housing market. Sales of previously owned homes is one. I think that data arrives Wednesday. Thursday, new home sales. How are you understanding the housing market right now and what the rates environment is doing, particularly the mortgage market, the impact it's having on the real estate sector?
It seems like consumers are continuing to be surprised that mortgage rates are staying this elevated, right? You're still seeing 30-year mortgage rates, between 6.5% to 7% at a time, and home prices are still very elevated. So overall, affordability is quite negative. Overall, and within the kind of in the micro level for housing, we've had such low inventory that only a little bit of demand has been able to clear these levels, but we have really seen a significant rise in supply. We saw supply rise over the last 18 months, almost every single month. And we actually see today as kind of more of a buyer's market, given there's so much more sellers in the overall housing market than buyers right now. And so home prices should continue to be softer. We don't see new home sales or existing home sales really surprising to the upside right now. we actually think that the housing finance markets are in great shape. But as far as thinking about where home prices are going, most likely they're going to be flat or potentially negative, next year on the margin.
I'd like to get your take on the muni market, particularly in the wake of the passage of the big, beautiful bill. This could end up putting a lot more stress on revenues for state governments. And I'm wondering whether or not you have to be a little bit more cautious when you begin to identify opportunities in the muni market going forward.
Overall, we do think that the short-term kind of changes for munis and for revenue, and as you mentioned, the big beautiful bill, that's really just kind of setting up buying opportunities in the short term. Over the long term, we've seen a lot of budgets kind of being fixed, and a lot of the asset liability mismanagement and pensions have improved so significantly, with stocks up so much. So we actually view anything kind of short-term vol and munis as actually a pretty strong buying opportunity. We saw that earlier this year, and if we see that again in the second half, we think that could continue to be another buying opportunity as well.
So broadly speaking, when you look at the fixed income space, Clayton, where do you want to be positioned on the curve right now?
Yeah, so we see really attractive opportunities in the short to intermediate term. On the long end of the yield curve, while the average 10-year real rate is around 200 basis points, and that only averaged about 80 basis points the last 20 years. It does look really, really attractive. That being said, with the unsustainable level of the fiscal side of the picture, we think there could be a lot of vol in 10-year yields and 20 and 30-year yields. And so we see much better opportunity in short and intermediate term fixed rate bonds. The easy money's kind of been made when it comes to investment grade corporates and high yield corporates, but fixed rate bonds within mortgage-backed securities, asset-backed bonds, and selective areas of corporates actually look really, really strong right now. We saw that for the first half of the year. Returns have been right in line with our expectations, and the vol has been so low for that portion of the market, versus if you look at the standard deviation of the S&P, it was around 30 for the first half of the year. So great returns in fixed income so far, and we think that most likely will continue for the second half of the year.
Clayton, we'll leave it there. Thank you so much. Clayton Triick there. He is head of portfolio management and public strategies at Angel Oak Capital, on the line from Atlanta here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.